All right, I think we have a quorum. Maybe now is the best time to get started. So thank you everybody for joining, and let's get into it. So I'll begin by reading a brief disclosure. Today's workshop is on diversify and conquer, so effective diversification strategies for your portfolio. Next slide, please. So this presentation is not to be taken as investment advice and should not be relied on for such advice or as a substitute for consultation with professional accounting, tax, legal, or financial advisors. The observations made are independent of Zoe Financial and should not be read as financial recommendations. There are also standard performance data and disclosures attached. I'll begin by introducing Rajesh Gaur, CFA. He is our head of investment solutions here at Zoe. We're very lucky to have him. Prior to Zoe, he was actually the VP of investments and head of trading at Robust Wealth. There he gained extensive startup experience while building a fintech platform. Prior to that, he was a VP at Merrill Lynch and was a key member of building out Merrill Lynch. So at Zoe, he has and brings almost 2 decades of experience in investments in technology. And here he spearheads the due diligence of our investment solutions, as well as creating financial tools for both advisors and consumers to use throughout their Zoe experience. So with that, I'll pass it over to Rajesh to introduce our guest for today.
Yeah, thank you, Alexandra. I'm really excited to join this discussion with Christopher P. Van Slyke. He is the founder of WorthPoint Wealth Management, and I'll just quickly read his bio. Fueled by his passion for empowering people and armed with decades of financial planning experience, Christopher founded WorthPoint, and he wanted to build a wealth management firm that went beyond the norm, exceeding clients' expectations to create secure financial futures tailored to their individual needs. Christopher leads an active life with his wife and 5 young children in beautiful Jackson Hole in Wyoming. Among the many hobbies they enjoy together: golfing, skiing, snowboarding, camping, and doing a lot of fun stuff. So welcome, Christopher. I'm really excited.
Thank you, Jeff. Thank you. I'm excited to be here.
Yeah. So let's just get started. So at Zoe Financial, as in a lot of webinars, we've discussed that our mission is to accelerate wealth creation through exceptional client experience and innovative technology. And one of the core missions that also we have is to help our clients find, hire, and work with our advisors, right? And in this workshop, we'll discuss a lot of different things. We'll discuss different investments and how we can group those together in asset classes. And the core of our workshop is going to be talking about understanding the risk, how that plays out in the asset allocation, and how we can, diversify the risk and essentially help clients achieve their goals, right? In the end, we will also have some time set up for Q&A. So feel free to post any questions in the Q&A or the chat box. We will queue all of them up, and Christopher and I will discuss that. All right, let's get started, Christopher. Just to set the stage, 58% of Americans invest in stocks to achieve their goals. And Christopher, you and I know, like, this U.S. stock market is one of the biggest wealth creation tools. And actually, this number actually increased from 56% last year to 58% this year. So it just means that stock market is one of the biggest wealth creation tool, and our Americans are investing in it. And I sincerely hope that this number keeps going up and up.
Well, as I recall, it usually goes up during bull markets, and it usually goes down a little bit in bear markets, understandably. as investors find out that it sometimes can be a little more challenging than they thought to be an investor.
Yeah, and also what we have seen on our platform is that, especially when there's down market, there is actually more need of advice, and clients reach out more to get some advice from the financial advisors, so that they keep track, so that they stay on track, right?
That's exactly right. People that I run into socially always think that things are going great when the market's going up, but actually people aren't really seeking advice so much when the market's going up. It's when the market's choppy that they decide to seek an advisor.
Correct, absolutely. US stock market is pretty big in the overall stock market, but just thinking globally, there are like 43,000 stocks, right? And all of those companies are different. Their risks are different. They may potentially bring returns back to the shareholders different year over year. Their management would change. So because there's so many stocks out there, it's always helpful to understand how do you talk to your clients about, like, okay, here are 43,000 stocks, or if we look at US stock markets, about 4,500 or so. How do you have that conversation with the clients around that?
Yeah, well, I mean, that's really the question. There's the global opportunity set, which if you add bonds is, I think, north of 400,000 publicly traded securities. So the question is, do we want to buy them all to be diversified, or do we want to refine that down to a smaller group that makes more sense for a particular client's goal?
Yeah. And even when you mentioned about diversification, diversification is different for a 25 or 30-year-old individual, and it could be very different from a 60 or 70-year-old individual who is actually getting into the retirement or actually in the retirement, right?
Absolutely, yeah. The portfolios are unique to the individual, and there are preferences within the portfolio, not only in terms of expected return preferences, but also values preferences. Some investors are concerned about the behavior of the companies that are investing.
Yeah, and actually thinking more about those values, that brings a different topic called like active. And active, what traditionally clients think is about, hey, active investing is all about stock picking. And if we go back in 1930s or 40s, there was only stocks to pick, right? And the goal was to actually beat the benchmark, right? And then came along some mutual funds, ETFs in the 1970s, 80s with 401ks being rolled out. That actually helped gain a lot of mutual funds, gain some traction. And with that came, we all know, Vanguard. John Bogle created the whole revolution around passive investing in a sense that, holding all the stocks in a certain benchmark and essentially accepting the market returns. But I'm sure we all know markets are pretty efficient. At least US market is relatively efficient, but there is always a dynamic where you want to be active in certain aspects. And I think your customization, the values that you are bringing, actually brings that perspective. So I want to learn more about that.
Yeah, I mean, really, the academics were kind of looking at the stock pickers and market timers and comparing them to benchmarks like the S&P 500, and they noticed that most of them weren't beating the benchmark, so they decided to offer the benchmark. That's called passive now, and active is the more, trying to find undervalued stocks. And then there's some approaches. It's kind of a continuum. We're kind of in the middle. We think what matters is portfolio structure. We don't just sort of buy and hold everything. We think that what you buy and hold for long periods has a lot to do with the outcome. There's a lot of academic research to support that.
Yeah, definitely. And I think that's how one should think in terms of portfolio management. It's not about just holding every stock out there. It's all about being active where being active actually pays, right? Being active in risk management, and that's exactly what we'll get into. Okay, so we have talked about all the stocks and different bonds, but because there are like so many stocks out there, I think as an investment professional, we all want to understand how can we explain so many different companies, so many different stocks, and better understand their risk and return characteristics. And one of the ways to understand is grouping them in a certain logical group so that we can make a better sense out of their expected returns, or I should say more around expected risk or volatility. Here are some of the asset classes, main asset classes: US large cap, US small cap. But the way to think about it is that these are the building blocks for building your portfolios. And the main thing about each and every asset class, they play a different role in your portfolio, right? Anything you want to add here, Christopher?
No, that's exactly right. It really is the way that you combine these is going to determine what kind of experience you have as an investor, and also what the probability is that you end up where you want to be down the line.
Yep, exactly. Okay. Switching gears, I think we just talked about different asset classes, their returns, characteristics, and I think one of the interesting aspects that we will drill into risk is, but before that, let's just see how the risk, or in fact the return, varies over year over year. This is the classic periodic table for asset classes over the past few years. And just by looking at over here, what we are looking at here is year over year return for different asset classes. And just look at S&P 500. Every single year, the return varies, right? And if we want to have a little more dramatic picture, emerging markets, this represents different risk and different return dynamics. But no one would be able to guess that one of the top performers in 2007 was emerging markets. It had about 40% return. But if someone were to guess the next year what the return expectations are going to be, no one would guess that it would be almost at the bottom of the periodic table, right? How do you talk to clients about this? Because this becomes a very difficult topic to grasp for our audience.
Well, everybody wants to know, next year what's going to be the hot asset class. And I think what this chart helps you understand is that predicting that is going to be impossible. If you look at 2006 and 2007, emerging markets were 33 and 40%. So a lot of people would think, well, you just put your money in emerging markets and you're good to go. But then the next year, it's the very worst asset class. And then the very next year, it's the very best. So I think the point of this is we don't want to try to predict which square to invest in. We want to invest in all the squares and then rebalance them annually. So as one asset class does really well, we want to trim that back and put it into the ones that didn't do as well, and do that systematically and sort of move down the investment field by being diversified into all the asset classes. I used to explain this also by a freeway example. You know how when you're sitting on the freeway and the lane next to you starts shooting by you, so then you jump in that lane, and then what happens? Then that lane stops.
That slows down.
And the lane you're in starts going. So we want to move with the flow of traffic, and that's really the best way I know of to explain what this really means to investors.
Yeah, and I think you mentioned a bit about rebalancing, and I think that's where the managing your risk becomes much more important. And all the techniques that you just mentioned, they actually help you manage the risk, which is what you can which is what is in your control, right? And that's where we'll dive deeper into. Great. I think this sets up well for our for the core part of our webinar, that we've already seen that it's impossible to have a single model that will tell you what the expected returns are going to be for an asset class over the next year, or for even further than that. The second aspect of any asset class is risk. And let's just quickly take a look at the capital market expectations that one of the top asset managers had put out. And I'm going to just talk a little bit about some of the asset classes. But the key thing is, if we just look at the expected return in 2020, and we don't forget COVID around that time, and right now, if we think of expected return in 2022, there has been a bit more change in the expected returns going forward, right? And also, there's a corresponding expected risk associated with those asset classes. What I have seen in the past couple of years, especially after COVID, supply chain issues, the recent macro events around Fed tightening the markets or increasing the rates, but then ongoing war, they have all put so much pressure on a lot of equities as well as fixed income market that researchers and all of us are not expecting that high of a return for the next 10 to 15 years, which is what this capital market expectations project, right? So these are not like point in time estimates, but looking at next, say, 10 to 15 year long-term market cycle. Anything you want to add here, Christopher?
Well, yeah, I mean, I think long-term returns are pretty stable, the return on equity or the return on fixed income. The problem is the order of returns. So, we expect stocks to have a nominal return between somewhere, between 9 and 10% over long periods of time. The problem is we don't know if this is 2019 or 2020 or 2021. And depending on when you retire, it has a big impact on what your growth of money is. So what we're trying to do by using asset classes and diversifying is smooth the returns so that you don't have as big a sequence of return problem.
Yeah, and I think one of the important aspects is that if you lose less in the earlier years when you start investing, you will have more to compound later on in your life, right? Which is what helps in terms of long-term, wealth projections.
Yeah, I mean, in plain English, you don't ever want to get into a deep hole in investing because it's very hard to get out.
Yeah.
So you want to limit the downs. Growing money is not about home runs. It's about singles and doubles. If you know anything about baseball, it's about consistent performance and not having big losses.
Correct. And I think we've already seen that in one of our charts earlier as part of the asset class periodic table, right? Returns are zigging and zagging in different asset classes. And the other aspect that I wanted to hone into for our audience is around the expected risk or the volatility, right? And also the correlation aspect that we'll just get into. But just thinking more about the risk part that we were just mentioning, if you just look at the expected volatility for US large cap over the past few years, you don't see that much variability, right? Which is where it becomes important for our clients to understand that this is the thing which is in your control. This is the thing that we as advisors or our clients can work together and control the risk part. We have seen that there is no way to model returns or expected returns for any of the asset classes going forward, right? And this becomes really important for advisors and clients to have discussion. Okay, let's just control the risk, control the thing that you can control, right? Otherwise portfolio construction would not give you enough risk to manage, right?
Yeah, I agree. I agree. Yeah, control what you can control.
Yeah,
We can make assumptions about long-term returns and volatility, but not the order of returns. So let's let you take the appropriate amount of risk for your situation, because we can
Yeah.
control that, and then we'll manage on an annual basis around what returns we get.
Correct. And I think the other topic that I wanted to highlight was the correlation. And this, people just don't talk enough about it, but think of this as one asset class zigs while other zags. And when that happens, you have an opportunity to be in different asset classes and essentially control the risk, which means essentially losing less in the volatile times like today, right? So that you have enough base to compound over a certain number of years. What I want to mention here is like range of correlation values from -1 to 1. In short, it just shows that how, for example, returns of an asset class, for example, US large cap, vary with the small cap. And say, for example, 0.91 is the correlation value between large cap and small cap. It just shows that they kind of move in tandem together. Whereas if you look at US aggregate bonds compared to US large cap, the correlation value is 0.01. That means they are less correlated, which is going back to your point about sequence of returns. This will help bring down the volatility, right? And this is the part where what you can harvest as part of the diversification that we'll talk about as through a couple of examples later on.
Yeah, what I like about this is it shows how important bonds are in asset allocation and diversification. So large stocks and small stocks are fairly highly correlated. They're going to go up and down pretty much at the same time. But if you really want to control risk in a portfolio, your stock bond decision is by far the most important. And you can see they're not highly correlated at all, which means it's very likely that when your stocks are down, your bonds will not be down, certainly not as much.
So correct, absolutely. Yeah, looking at the next slide, this is a beautiful chart. So why don't you explain that for our audience? And I think this just basically captures so many different aspects in just one slide.
Yeah, I used to do a presentation with only this slide. So I can use this to explain a lot of things. I like to show, first of all, how money grows over time and how important compound growth is. So what this shows is a dollar invested in the beginning of 91, really at the very end of 1990 through the end of July this summer. So if you played it safe and you bought T-bills, your dollar looks like it grew to about $2. That's on the bottom line there. But you notice it's very smooth, right? Their one is very stable, not a lot of volatility. On the other end of the spectrum, if you bought the US market and you favored profitable companies over unprofitable companies, your dollar grew to almost $40. So the risk decision you make plays out over time and becomes more and more important. The other thing I like the way this shows is that part of our investment philosophy is in portfolio structure, not really which company or when to buy it, but in the types of companies you own in the portfolio. And you can see that, say, the S&P 500 is the blue line. So your dollar grew to about $22 over that period versus the $40 in profitability. And let's see, in value, about $35. And so it just kind of lays out the risk return story so that you can see how important compound growth over time is and how your choices, which don't seem that significant in the short term, over a lifetime, it really means that the amount of money you have is very different.
Yep. And I think one of the things that I took away from this one was, if you just look at S&P 500, it has a lot higher highs, right, compared to, say, for example, US core index or T-bills. There's a lot of variability during the 30, 35 plus year time frame. And it becomes very important for clients to understand that you need to be able to adjust that volatility or be able to live with that volatility. Because suddenly, if you think that the money you invested that grew from $1 to 50 and suddenly it has dropped to 40, right? It's a huge loss. It's a 20% drop. Can you withstand that loss, right?
Right.
That also becomes very important as we get into our overall asset allocation.
Yeah, I like to look at 2008. Everybody remembers the 08, 09 market crash related to the real estate bubble. And, everybody wants their dollar to grow to $40, like the top line, but take a look at how stock prices plunged from 08 to 09. Unless you're pretty young and you had a long time to recover, that could have been devastating to your retirement. So it does. If you were a client of ours, you wouldn't have had all of, say, the black line. You would have had a lot of the red line with your black line, so that the plunge wasn't as much and you could ride it out.
Correct. And I think that's where the asset allocation comes into picture, like how we can mix different asset classes together to create a diversified portfolio, and especially as we talked about diversification, that it not only offers you the managed risk aspect, but it also helps you grow more responsibly, right? So just by looking at some of the sample asset allocation, we have, if you're a 25-year-old individual, you could be like 100% in stocks, but at the same time, there are different clients and they have different risk preferences, they have different risk capacity, risk tolerance. You could be looking at like 40-60 stock bond portfolio, or 80-20 stock bond portfolio, or you could be looking at different asset classes put together that will help you manage through the volatility over a long run. Next that I want to talk about is like the diversification, which is what the output of the overall asset allocation is, right? And I think it would be very helpful for our audience to go through a couple of diversified portfolios that you and your team have put together, and we can hone into the point how diversified portfolio can help you achieve the growth while keeping the risk to a managed level.
Yeah, we're going to have two examples. One's going to be John and Jane. John is a younger investor with many years to recover if the market should fall in the short term. You can see that they're broadly diversified internationally and domestically in different asset classes. Each slice shows you a little bit different asset class. And then we're going to show you what happened over the same period, that same 32-year period where we showed you the growth of $1 on the 2 slides ago. We're going to show you what happened. So $1 in John's aggressive portfolio had a return of 9.75%, and that's net of an advisor fee and net of the fund costs. $1 grew to $19 over that period, and the risk was 16.2%, or you could do 16.25 cents better than 9.75% or worse in a given year. That's what that means. And John also had some concerns around climate change and didn't want to invest in oil companies. So those were excluded from his portfolio. So this is one type of investor, but you can see this is uniquely built for John's needs.
Correct. And I think the important aspect is like this growth from 1 to 19 is over the period of time, but at any given year, if you invest $1, there is $16.25 is actually at risk, right? And this we can easily contrast with our next example.
So here's Jane. Jane is probably in her 60s. She's near retirement. She's going to be taking income from the portfolio. So 50% of her money, half her money is in bonds, which if you remember from the asset class chart, didn't grow a lot over time, but was very stable in the tough times. So let's take a look at what her account did over the same period. So the return was 6.5 versus 9.75. $1 grew to $9 instead of 19, but she only had 8 cents at risk versus 16. So she had about half of the potential for loss as John's portfolio. And she was concerned about family values and didn't want to own any entertainment stocks. So her portfolio was tailored to not only her financial goals, but also her values concerns as well. So you can see how different they are as people and how the portfolio is customized to produce an outcome that's suited to where they are in life.
Yeah, and I think if we just compare and contrast both the portfolios for their clients, they're both diversified, but the risk in both of them are different. In one case, you could lose almost 16.25 cents within a year versus half of that, 8 cents for this portfolio, which again shows the, I call it power of diversification, right? Diversification is a free lunch, but we need to be able to harvest that, combine those asset classes, and being more disciplined around portfolio rebalancing throughout the time period.
Right. So I think the point is you can invest in everything, but you should probably refine it down to something that's appropriate for you. So just like I have here in my summary, I'm going to start with the global market portfolio. If you bought every stock and bond, you'd be about 60% bonds and 40% stocks. That probably needs to be adjusted for who you are by trimming back the stocks or the bonds. So in the case of Jane, we had half stocks and half bonds, and John, we eliminated all the bonds. We want to tilt to those factors. So you saw on the growth of a dollar chart where the profitable stocks grew to $40 and the S&P grew to about $24. So we want to decide which of those factors should we tilt towards in the portfolio. And then number 4, finally, we want to use value screens if the client's concerned about the ethical behavior of the company. Do we want to eliminate certain types of companies or business practices from the portfolio depending on the values of the client? So that's the way I see it. You start with everything, you slim it down with the stocks and bond decision, which is the most important to control risk. Then you decide which returns factors to focus on to try and enhance returns over the market over time. Then you put in the value screens based on the conversation with the client and what's important to them about the behavior of the companies, and out comes a portfolio at the bottom. You match the portfolio to the client's goals, and over time you may adjust all of these factors in real time, depending on what's going on in the client's life, depending on what's going on in the market, et cetera. But that's basically the process.
Yeah, and I think the point that we're making here is, again, control what you can control, right? And put together all the different asset classes so you can bring down your risk. And over a period of time, along with the customizations, you can be disciplined in terms of portfolio rebalancing and essentially achieve your goals, right? With a disciplined approach. Awesome. This was
and over time, a financial science reveals new information about portfolio construction design, and it's our job to have a conversation with the client about whether they want to implement that into their portfolio. Over my career, these factors and what we know about them have changed considerably, and so it's not kind of a set and forget it. It's an ongoing process with the client, not only in terms of their goals, which are a moving target, but in terms of what we know about financial science and markets themselves.
Yeah, and also one thing that just struck with me is, like, it's not just the investing styles that are active. There are so many different active aspects, like active portfolio construction, actively managing risk, and actively having conversations with your advisor to ensure that you can discuss your current risk tolerance. You can, discuss about current life events that can help you either change some of the asset mix that we have seen, or if we need to take more risk, or if we need to take less risk given the situation that we have. And that also is an active component.
Absolutely. People's need for risk changes over time. You get older, things happen in your life that make you feel like your appetite is increasing or decreasing. First, the external world can get pretty crazy. And, it's an ongoing conversation about what this portfolio should look like. Definitely people's lives change, the investment world changes. So over the 20 plus years I've been doing this, we've had many, many conversations with clients about how to optimize what their portfolio looks like relative to who they are as a person and their goals.
Correct. Awesome. Fascinating discussion. Thank you. And I just want to turn back into, why did you become a financial advisor? And again, I know you founded the company, but if you could give us like little background, that would be very great.
Well, in finance, I was good at finance and economics, so I majored in it. And in the world of finance, there's kind of the quantitative side, and then there's the people side. Mm-hmm. And what I learned about myself, as I had several jobs on the quantitative side, is that what I really get out of this is sitting across the table from real human beings, helping them make these decisions and seeing the impact on their lives over time. I personally really thrive on that. That's why I'm an advisor and not an analyst or something like that.
Awesome. And why did you, start the company? What was the background story around that?
Well, I'm the son of a lawyer, and he was a very conscientious lawyer. And I knew what a fiduciary was when I was a kid. Fiduciary is a professional that has to put their client's best interests before their own. So I was already kind of programmed that way. And most of the industry when I started didn't work that way. So your advisor didn't have a duty to put your best interests first. And I kind of knew that there was a way to put a business together that was built on the fiduciary concept, and which was pretty unheard of for retail clients back then. And so that's why I set it up. It's because that's really the only way I could do business, was in a fiduciary fashion. So there weren't a lot of fiduciary businesses like WorthPoint back then. So I just created one.
Awesome. Great. And actually, for our audience, that's exactly why we exist, to have such advisors, fiduciary advisors, vetted, curated advisors on our platform, so that our audience doesn't need to reject 95% of the advisors. We do, we curate a list of great advisors like Christopher on our platform. And here are some of the ways that our audience can connect with us, the phone number, email address. Feel free to send an email, and our team will get in touch with you. I think this is a good time to pick up some of the questions. Let's see, Christopher.
Oh, I see one here for you, Christopher, from Sergio. He asked, what exactly is unsystematic risk? Could you expand a little bit on that one, please?
Unsystematic risk is the individual companies in your portfolio. So if you have a one stock portfolio, your standard deviation, your volatility is going to be very high. If you keep adding stocks to your portfolio, it's going to go down, so that one particular stock doesn't impact the portfolio, but your whole portfolio can still go up and down with the asset class. That's the systematic risk. The unsystematic risk is the individual securities in a portfolio.
Yeah. Correct. And I think, and just to add to Christopher's point, the reason we are discussing about risk is that we need to minimize that post-systematic and unsystematic risk, right? unsystematic risk we can minimize by having certain asset classes or stocks within an asset classes that we think are going to perform, that brings down the unsystematic component, right? So again, the point here is to make sure that you can control the risk and focus on risk diversification.
Nice. I see here David asked, what is the role of financial advisor on my diversified portfolio? So I think we've expanded on that quite a bit, but we would love to hear from you, Christopher. What do you think? What are the unique elements that you bring in when thinking about the portfolio construction of a given client?
I mean, the role of an advisor, period, I like to think of a personal trainer. I'll grant that many of our clients are super intelligent people. I like to think of this in the context of a personal trainer. Why do you have a personal trainer? Well, I don't know about you, but if I don't have one, I tend to not show up at the gym. I tend to not work out quite as hard. My form isn't quite as good. So it's really the same in the role. We're really a coach. We're an informed coach, but it's our job to use our financial expertise to help you make good decisions. And just having someone who's not in your shoes help you make those decisions over time, we think adds a lot of value.
Definitely.
Great one. I see one here from Dylan. Dylan says, Christopher mentioned that long-term returns of equities or bonds are pretty standard, but sequence of returns is what matters. Can you please expand?
Long-term returns, if I look at say 20 or 30-year rolling monthly periods for stocks, they're pretty consistently around 10%. But there are some periods where they definitely are not 10%. So let's take 2008. Everybody remembers that. The next year, 2009, I think the S&P return was minus 30 plus. So certainly the average might have been 10%, but if you retired in 2008 and your next year was minus 30, then your retirement would look very different than somebody who retired in 2009, for example. So when you retire or when you begin to withdraw money has a lot to do with how much money you can withdraw. So that's called the sequence of returns. So the average is going to be 10%, but that could mean a very poor start and big returns later, or vice versa. And which one it is has a lot to do with the outcome that you are going to be facing as an investor.
Right.
Super insightful. Thank you. How about this one? So this is from an anonymous attendee. They ask, does an advisor help me with my tax optimization?
We certainly do. We do tax optimize the portfolio. And then our business model is basically an outsourced family office model. So we're going to be working with your CPAs, with your attorneys, with your outside advisors to do the advanced tax planning. So we don't give tax and legal advice. We do portfolio tax management, but even that we're going to do in conjunction with your CPA tax advisor. Because it's not in isolation. So we may be able to tax manage in the portfolio, but you may have things going on elsewhere in your taxable estate, and we need to know about that, and they need to dovetail. So yes, we do it. We're kind of the quarterback. Our process helps us address what we call the advanced planning concerns, which are tax, legal, risk management, and charitable giving. We do that by helping assemble an expert team that we work with over time to coordinate things in terms of where you are now and where you want to go.
Fantastic. Here's a bit of a contentious one. Is there such a thing as over diversification? What do you two think?
Well, over diversification. There's nothing wrong with buying the market portfolio. So no, you can't over diversify unless you spend too much money trying to get so diversified, but you can do it fairly cheaply. I think the question is, does focusing the portfolio give you a better option, a better chance for achieving your goals than just buy maximum diversification. I would argue that having your portfolio be smaller, more profitable, and more towards the value end of the spectrum will give you a higher expected return on your stocks. So I'd say being a little bit more focused would be useful for you as an investor. So you really can't be too diversified. It's not a bad portfolio. I think you could have a better one if you became a little choosy.
I have a different views on that, Christopher. I think over diversification is people think like, hey, bring everything together, buy all the stocks, great. But you don't want to be like 80% bonds and 20% stocks when you are 25-year-old. So for me, that is over diversification at the wrong time when you need to be taking a little more risk, whereas someone who would be like, say, in your 70s or 80s, and if you are taking 80% stocks in a portfolio, then you are basically taking too much risk, despite having a well-diversified portfolio.
I certainly agree. And by diversified, if you're taking an inappropriate amount of risk for your stage, you're leaving a lot of money on the table. And I would say that is definitely a bad idea. You can be too cautious, for sure.
Right.
And I think for our final question, I see here, is there anything I can do on my day-to-day to maximize the returns of diversification?
I wouldn't say on a day-to-day basis, no. This doesn't really, in my view, portfolio construction and management is not a day-to-day process. Now, we're managing trade costs as you have cash come into your portfolio and go out. We want to manage the expenses. So if you're trading your own portfolio, managing costs, especially trade costs, would be really important. But, you know, steering a portfolio is kind of like steering a cruise ship. You know, if you're on a cruise to Hawaii, you're not making hard lefts and hard rights. You're steering the boat. You're making small steering changes to make sure you get to Hawaii, which in the case of your financial goals is your cash flow needs, your retirement destination. So no, I wouldn't look at it from your perspective as a daily activity, unless you're actually doing the trading at the very base level of the portfolio.
Yeah, and in fact, like looking at your portfolio daily can make you trade more, which can, you know, which again, we all know that markets are pretty efficient. There's a lot of volatility, but also you will rake up a lot of commission costs in there as well.
Yeah, it can usually causes more problems than create solutions.
Got it. That is very helpful context. So I know I said that was our last question, but we just got another really good one that I think is worth answering. This one is from Vijit Master, and he asks, do advisors reach out when there is a good investment opportunity? Similarly, when they perceive risks are high and do not wish to make any new investments? How do you approach that personally, Christopher?
Yeah, I'd say our outbound communication is event driven. You know, when there's something in the external world that we want our clients to pay attention to, we try to actually send out an email to have that when they kind of, we want them to wake up with the answer to their question before they even need to call us. But in some cases, unique to the client, then it's appropriate for the advisor to reach out to the client and talk to them specifically about what's going on.
Awesome. Well, thank you so much. If we could move over to the next slide there. We'd love for everyone who joined today's webinar to share with friends and family. We so appreciate everybody joining. I want to give a special thank you to Christopher. Thank you so much for your time, as well as to Rajesh. You both were excellent and incredibly insightful on all of these excellent topics.
Thank you for having me.
Thank you, Christopher. It was a great discussion. Thank you.
Thank you so much, Christopher and Rajesh, for these valuable insights. And thank you to everybody who was able to join today's workshop on Diversify and Conquer. This workshop will be available via recording, so keep an eye out for an email in your inbox. You'll be able to see it there. And be sure to share with friends and family. Thanks so much, everyone. Bye.